Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of April the 25th, 2016. Now to get started this week we're going to begin where we always do with the US dollar index. Now we're coming off the ECB. The ECB not really saying anything we didn't already know. They're basically talking out of both sides of their mouth, but we really want to look at the price action and the major intermarket correlations to determine which way the dollar is going to go. Now right now we can see we have a trend line break. We've closed above the key VantagePoint level, 94.81, and the dollar is starting to build momentum again. Now, some of this is actually being fueled by the Bank of Japan. Fundamentals still play a part in our trading, without question. We just have to understand what those fundamentals are. So this past week, we've had the ECB, but we've also had the Bank of Japan talking about offering negative interest rate loans. This sent the Nikkei higher, and it sent the yen moving much lower. So that's where a lot of the dollar rally has actually come from. So it's highly questionable here, guys, whether that rally has any legs to it or not, because in most cases when a central bank tries to deliberately weaken a currency, it almost never works, not for any long period of time. So we want to keep this in mind. Right now the predicted short, medium and long-term differences are moving up. A lot of market pundits, analysts believe that the euro is going a lot lower, but we're going to have a look at that. I'm not convinced that that's actually what's going to happen. Now, with that dollar, we can see here that our short-term crossover, again, very important that we're checking them all here. Our short-term is good, our medium-term is good, and our long-term is good. So I would say that it's reasonable that the dollar will see at least 2 or 3 days of strength going into next week. Now, that direct strength, however, is being fueled by the equity markets, specifically the DAX and the S&P 500. So in theory, the global equity market need to continue to move higher in order for the dollar to move higher. That's essentially what we're looking at. Now we have this trend line break from last week, and again the dollar's had a pretty decent week, but you can see that the DAX is moving into very, very heavily overbought territory, excuse me. Now the much bigger concern I have here going into next week on the equity markets, and if the equities need to move higher for the dollar to move higher, we can see that on a year-over-year picture here, it really doesn't look good for the S&P 500 at all. So I'm going to draw a line. I'm going to basically draw this line right from where we were essentially at or about 1 year ago, and you can see that we're really not making any new gains on the equities at all. We're simply retracing back to where we were. So for the S&P to really turn bullish here, guys, and the US dollar to turn really bullish, the S&P needs to be over 2120, 2130. Any price below that not only tells that the equities are likely to sell off, but the dollar is likely to sell off with it. So be very, very cautious here when we hear people talking about the S&P to 2200. We hear all these different numbers being thrown out. This is the reality of the situation of where we're currently at, and this is a very, very big, this is potentially a quadruple top in the S&P 500. So there's a few things we have to be cautious of here. Buying up at these levels and playing a breakout on this is basically a classic bull trap. So what I mean by a bull trap is the market's moving up to this area, the bulls think they've got full control over the market, and then the bears just drive it lower. So be very careful. If the S&P sells off, then chances are the dollar is going to sell off, at least against the euro. Okay. Now, of course, we need oil moving up also to support that. If the equities are truly going to move higher, the DAX, the Nikkei, the S&P 500, then we need oil pushing higher also. And you can see that oil is really struggling here. Now, our key VantagePoint level comes in at 41.59, 42.68, and 43.45. So right now, we are bullish on to some degree on oil. It looks like we could push higher here, but we've got to get moving on this. You can see this congested area of resistance here along the trend line that I've drawn in. So if this can't get moving, if it can't go up, then it is going to move considerably lower. But predominantly, and again, we want to start looking at these seasonalities at this time of year. Oil usually peaks, right up until about the mid-June. So this should be the strongest period. for those oil contracts. But again, it needs to get moving. It absolutely needs to break free of this $45 per barrel mark and get back out of this area and start moving back up into our former swing highs towards I'm not saying we're going to get $60 a barrel, but I want to see over 50, and I want to see it very, very soon. Now, the same thing applies to gold here. I really don't see anything has changed in gold. We are getting extremely toppy on this once again. If we look at it on a year-over-year basis, you can see that basically last year, gold peaked in the month of May, basically May the 22nd, gold had peaked, and then the remainder of the year, it just continued to move lower until it bottomed out down here at 1050, and then we started moving up again. So once again, there isn't a lot of fundamental reasons to be buying gold at this particular time. We've got a few things coming up, the Greece loans, they're going to default on their debt again. That'll probably give gold a little bit of a boost, but not a lot here, guys, not a lot at all, okay? So when we get into our major currency pairs, we're going to do this a little differently this week so everybody can really see the intermarket correlations in action. That's what we want to basically know and understand. So right now, when I look at the euro currency, I see a very, very mixed bag here, actually. So I'm going to draw our trend line in here, and we're going to identify some key vantage point levels. That would be 112.80, 112.72, and 112.53. We've had a bearish close on Friday of 112.18. Now, the majority of the indicators are pointing lower on the euro-US pair. However, what we want to do is look at this a little closer here, guys. Definitely want to look at this a little closer. So this week, I'm going to take a few pairs excuse me, and bring us right into real world intermarket correlations so we can actually see them and what to look for. So what we can assess here is the Euro-US, the driver of the Euro-US currency, is not only the dollar index, but it's the DAX 30. We can see when the DAX 30 takes an aggressive move higher, the Euro currency immediately responds by selling off. These intermarket correlations are very clear. You can see them everywhere along here. The DAX goes lower, the euro spikes. The euro goes higher, the DAX goes lower. So right now, a bit of a concern here on these equity markets on the DAX is that the ECB was not really crystal clear on what they're going to do. So for now, we need the equity, the German equity markets, the global equity markets in general moving higher here, guys. That's how we look to trade oils, or to trade the euro-US pair, excuse me. So we can also see that as oil moves higher, that also pushes the euro-US currency down. Gold is definitely a factor with the euro. In most cases, it moves with gold goes up, the euro goes up. So you can see we're kind of stalling there. But again, and of course the dollar index is a key player here. The dollar index down, the euro-US currency goes up. So right now we've got a medium-term crossover on the US dollar index, which is suggesting that we could be getting ready to move lower on euro-US. Absolutely. But we want to point out the real-world intermarket correlation, specifically that S&P 500 and that top that I've showed you guys here. So basically we can see that every time the S&P 500 goes up, the euro goes lower. So there is a period of time where they can both go up at the same time, but predominantly it's an inverse correlation right now. You can see the most recent crossover from VantagePoint, S&P 500 up, euro-US immediately lower. So again, we've got to be very, very cautious going into next week's trade to watch those equity markets very closely when we understand clearly what's driving the euro currency. Commodity prices, equity prices. These are the real drivers behind the euro. And you've got your basic fundamentals. So we've come through the basic fundamental of the ECB and it's passed. So now we go back to our normal intermarket correlation should take hold. Now with our US Swiss franc, this is 100% correlated to the basically to the US dollar index. So when we look at this, we want to make sure that we understand what exactly we're trading off of. So in the case of US Swiss franc, it can move separately from the euro US, but the main driver is of course the dollar index. So as long as the dollar index is going higher, Equities are going higher. US Swiss franc is going higher, guys. So their main level here, 96.74. We need to stay above this level for next week. So we would be buyers down to this level. You can see that our other key levels, 97.52, 96.99, and a very bullish close excuse me, of 97.79. So as long as we're holding above 96.74, the key vantage point predicted moving average, then we're long. That's how we play this. We let it pull back so we can buy more. The additional indicators from Vantage Point fully supportive of that long trade at this current time. But again, I have concerns on the dollar index based around that correlation to the global equity markets. If the global equity markets turn lower, the dollar index will turn lower. Okay? So when we look at the British pound for next week, we appear to be quite bullish on the British pound. We can see that the key vantage point level is repeatedly held through last week's trading session, all 4 days. You can see last Monday, a week ago Monday I should say, we've crossed the vantage point. Triple AMA cross has crossed to the upside, and we've had minor retracements back into these key levels, 143.51, 143.04, but the real big area right now for next week, guys, 142.67. We've got a bit of a mixed bag. Our neural index is down, so we want this thing to pull back towards between basically 143.51 and 142.67, where we would be picking this trade up on the long side. Now, again, looking at our short-term crossover, everything is good. Medium is good. Long-term is good. All of our crossovers are supportive. The neural index, of course, struggling a little bit, but it's a short-term indicator, guys. 24-hour indicator. It's not a long-term indicator. The long-term indicator, medium and long-term indicators here say that we are going higher. The Vantage Point predicted RSI breaking above the 60 level. That is very bullish. Okay, so don't let a pullback on Monday or Tuesday scare you. Just wait for it to come back into that area that I've talked about, between 143 and 142.60, and pick up your longs there. Now, as we come into the dollar yen, I'm not going to spend a lot of time on this dollar yen trade this week, guys. We have a massive bull candle here from Friday after the stunt, and that's the only word I can use here, the stunt that the Bank of Japan has pulled to weaken the yen prior to the FOMC. So what they've said is they're talking about negative interest rates on their loans. That, again, weaken the Japanese yen. In my respectful opinion, they are manipulating things. The Bank of Japan is known for doing this. It is very, very unlikely here, guys, that the dollar yen is going to hold these gains. Whenever we see a big bar or candle like this on a Friday, there is almost never any follow through. I'm not saying never say never, but what I'm saying is that this is manipulation, right? So whenever a currency pair is manipulated by a central bank, we best stand aside. Because in most cases, what goes up that fast comes down even faster, okay? And that's the best case scenario I can say to you. Our indicators here are bullish for the time being here. The key vantage point level now is 110.19. I would say that there is a better than 50% chance that we are going to come back down to this level in the next several trading sessions, probably by Wednesday. Now, another driver of this will be a sell-off in the equity markets. If the equity markets sell off here, guys, dollar yen is going lower. I don't care what the Bank of Japan says. The intermarket correlation is crystal clear that again, dollar yen pair, it needs the equity markets going up. If it doesn't get it, it's going to turn. So right now for next week, again, I would look for a move back down to the 110.19 area, and if the S&P 500 fails up at those levels that I talked about between 2100 and 2130, then the dollar yen is coming back into the bottom of this range down in the 107.50 area. So that is the likely outcome there. Now, as we come into our USCAD pair, USCAD is usually the Canadian dollar is usually fairly strong at this time of year, but it's been unusually strong for a very long time. Our trend line now is coming right even with the Vantage Point predicted 18-day predicted moving average. 128.73 is your major resistance for next week. Selling into that area is a preferred strategy based around the indicators here. Again, our predicted MACD well below the zero line, as is our predicted RSI. Our individual crossovers, even though we were a little mixed this week, our short is still down, our medium term looks good, and our long term looks good. My only concern with the short trade here is, again, US-Canada needs oil prices and equity prices, of course the S&P 500, the global indices, moving higher in order for it to keep moving lower. So if oil turns lower, if the equities turn lower, USCAD is a great buy here, guys, okay? But for now, we're going to stay on the short side while below 128.73, that key vantage point level. And again, watch those shorter term indicators for a potential reversal. Now, as we come into the Aussie dollar here, I've talked about this over the last several weeks about its extremely high correlation to the global equity market. So you can see throughout my presentation that my focus is not necessarily just on a single currency, but what drives those currencies. Okay, so what drives the Aussie US higher is when the equity prices go higher. Case in point, when we look at the Aussie and the New Zealand pair, we bring them up here so we can see these intermarket correlations in real time. Even though the software is calculating 25 other markets, we still want to take a moment to look directly at these intermarket correlations. It only takes a moment to do, and you can see very clearly here that as essentially even the price of oil is very correlated to the Aussie dollar. But the real big one here, the Nikkei, you can see as the global equity markets push higher that the Aussie currency immediately responds, right? So this is where can become very complex, but not if you understand that we group our currencies by way of in blocks. So we have our US Swiss franc, Euro US, Great Britain US, Great Britain, I would say more dollar yen is in one grouping. Then we have our commodity currencies, the CAD, the Aussie, and the New Zealand. So when we look at these currencies here, these currencies, they need equity markets to go up. They absolutely need commodities to go up. So right now you can see for the Aussie to keep moving higher, we need the equities to keep moving up. So I've already got concerns here where you can see that I'm drawing this in where we've broken above this resistance area, this channel that we were running in for the last couple of weeks. We had a break of this channel. The question is now, can we stay above this area? That is the critical question right now. So is this a false break? So we need those equity markets. We must have them moving up. So as I look at my global indices here, even if I look at the S&P 500, you can see that basically if I black the S&P 500 out and I black the Aussie US out here and I didn't tell you which one was which, it's very difficult to tell these two charts apart. They're almost identical. Okay, guys, so this is what we really want to keep an eye on. Even the DAX 30, but you can see that the Aussie currency is very sensitive to the S&P 500. Of the global indices, for whatever reason, that's where the highest correlation is. Okay, so if the S&P 500 cannot get moving here, then Aussie US is getting ready to turn back lower, not higher. And that's what I like to point out to everybody. So, copper prices, gold prices, absolutely copper is a big correlation here. You can see copper. So keep an eye on commodities like gold, but more copper than gold if you're trading the Aussie. But the S&P will determine the fate of the Aussie US currency, guys. And that's not me. To clarify it, it's not me saying that. That's the market. The market is talking to us here. The problem is most people don't want to listen to what the market has to say. And it's very clearly saying that, in order to buy the Aussie currency, we have to have the S&P 500 continuing to move higher. And the fact that it's starting to turn lower and a new trend line could be forming up here, or in the alternative, we simply have a triple top forming up here at or about the 78.30 level, then we've got a problem here. The neural index is already picking up on this, guys, pointing down, the strength indicator down, short-term predicted difference down, MACD crossing the trigger. The RSI unable to hold above the 60 level. Now it's breaking the 50 level. This is a very potential bearish setup here. So, but we don't want to get too excited in shorting it. We have to understand that the key vantage point level here is sitting at 76.59. We've closed at 77.04. So a break of 76.59 will trigger a bearish move on this pair. But right now, we could come down to this level just like we did last week, kiss the VantagePoint 18-day predicted EMA, and bounce higher. So remember what I've said, it's not a given that this is going lower, okay? So if we look at our short-term crossover, we're down. Our medium term has not crossed the trigger, and neither is our long-term crossover. So this is where traders have to be a little bit more vigilant and patient just to make sure of confirmation. If they're going to go for a trade, if we're going to go short here, guys, then right now we would be probably shorting into the 78.20 area, but we would be very, very cautious at 76.59. On a break of 76.59, then we can look to get bearish again here, but our lower trend line coming in about 75.20, that's a reasonable target at this particular time that we're coming back. Now, if we lose, if it comes to fruition, like what I've discussed here, that the S&P does sell off, Aussie US moves lower, if we break through this trend line at 75.20, we're looking at a very big reversal or a continuation of the overall downtrend. When we look at the Aussie currency on a year-over-year basis, we can see that this basically, we hit our peak here in the month of May in 2015, and the Aussie currency went from 82 all the way down to 68. And if anybody goes back and looks at my Forex Weekly Outlook from 2015, I was been very, very bearish on the Aussie at this time last year. So we could just simply have a repeat of history. These repetitive patterns, you know, that's the beauty of currencies, guys. They're not like crazy stocks that move 10% of their value per day. These currencies are very, very repetitive. They move 1% of their value per day. They're very slow moving trends. So if we look at it from where we were 1 year ago, we have no new highs here. None. Right? So it's a little difficult to paint a bullish picture on this particular pair at this time. Now, when we come into the New Zealand, the exact same thing here, guys. So if we come out, we look at our seasonality of things, we can see that New Zealand basically hit a peak here just under the 78 level in May, the end of April, beginning of May 2015, and it plummeted from 78 all the way down to 62. And you can see at this chart that this absolutely looks like a corrective move in a broader downtrend, not uptrend. So the driving factor between the Aussie and the New Zealand currency is going to be whether the equity markets can break out to new swing highs above 2130, above 2150. If the equities push higher, then New Zealand US and Aussie US will both reverse and go considerably higher, but that's what we need. So we hear a lot of wild and wacky theories in the market, Elliott wave, Fibonacci, Gann theories, all these different things, 200-day moving average crossing over the 50 moving, all these complex things that when it comes down to it, the intermarket correlations are going to trump any other indicator that we currently use.